Hi, so today's video, what I want to talk about is what to do if your business isn't making enough profit to pay dividends. What I mean by this, if you've got a certain amount of money you have to take out of your business every single month, probably because you've got a house and you've got a mortgage and you've got bills to pay and you've got a family to feed. Well, if your business is going through a rough patch and the profit it's making or not making isn't enough to cover in dividends the amount of money you need to take out, what is the best option for you? So this video is really important because actually a lot of businesses at the moment are struggling, and based on what's going on in the news at this point in the year, it's going to be rocky for a few more months from the looks of it. But ultimately, what I've seen over the last year is certain people who have to take a certain amount of money. The easy thing for someone to advise you is if your business doesn't make enough money to pay you, then just don't take the money out. But that's not realistic. Sometimes actually, like you do have to put yourself first. And if you can't pay yourself dividends, because dividends have to be paid out of cumulative profits. So that doesn't just mean you have to be profitable this year. It means you have to have been profitable enough this year to make up for any losses you might have made in the past from the beginning of your business. So that can be challenging. It might even be you've been unprofitable last year, but you're profitable again this year. However, because the cumulative profits haven't caught up, you can't pay those dividends. Well, you've got two options in that. Well, three options. The first one I said, take less money out, but that might not be an option. The second option is take the money out and be overdrawn on your director's loan account. Or if you actually were owed money from your company to you on your director's loan, then take money out of there rather than being overdrawn on your director's loan account. But assuming you weren't owed any money, then you sometimes have to get into a position where you owed the company money. There can be tax consequences to it, and there can also be personal consequences if your business goes into administration and you need to wind it up. So that's a second option. And the third option, which really you should consider in that situation, is just take a higher salary. Like usually as a director and shareholder, you might be taking a low salary to use up your personal allowance. And then you might be taking dividends. If your business can't afford to pay you dividends, actually the most sensible thing to do in that case is just to take a higher salary. There can be tax consequences to that as well. You'd have to pay income tax on it, employers' national insurance, maybe employees' national insurance. But that can often be better than being overdrawn on a director's loan account and then ending up with what you call Section 455 tax and the huge risk of insolvency practitioner or official receiver trying to come after you for that debt if something happened to your business. If you're going through this kind of issue and you need someone to talk it through with, then definitely get in touch.